The rich aren't rich because they are reckless. They're rich because they know how to be reckless in layers. While you see them betting big on startups and crypto, you don't see the 4 layers of financial armor they've built underneath. Today, we're revealing their 5-tier blueprint for building an unshakable financial fortress. Why do some people collapse after one bad investment, while others seem to weather every storm and come out richer? The answer isn't luck, it's structure. Smart people don't ask, "What should I invest in to get rich quick?" They ask, "Which asset tier am I building right now, and is the foundation below it strong enough?" The goal is to grow your bank account, not your ego. This is a fundamental principle of wealth that is often forgotten in a world of hype and speculation. Let me tell you a secret. The rich are not rich because they are reckless, but because they know how to be reckless in layers. You can see them investing tens of millions in real estate, some even buying crypto, playing with stock derivatives, and pouring capital into unproven tech startups without a tremor. You might think they are just lucky or have more guts than others, but what is the real truth? The truth is they don't bet everything on a single high-stakes gamble. The truly rich are not recklessly foolish. They only take risks in pre-calculated zones, and only when there is a thick enough, safe enough layer of asset cushioning underneath them. If a high-risk investment fails, they only lose the part they were always prepared to lose. The rest of their entire financial structure remains as solid as a rock. Conversely, beginners and amateurs often do the exact opposite. They have no emergency fund, no foundational assets, no real financial system. Yet they bet it all on one deal, often just because of a whisper they heard or a desperate hope of getting rich quick. And then, just one unexpected headwind is enough to sweep everything away. Imagine you are building a 5-story building, but instead of laying a solid concrete foundation, you just start stacking floor upon floor with borrowed bricks. One day, the 5th floor collapses under its own weight, and the entire financial structure comes crashing down with it. Your assets are like that building. If you don't build from the foundation up, you are playing a dangerous game of chance with your future. Therefore, smart people don't ask, "What should I invest in to get rich quick?" Instead, they ask, "Which floor am I on in my asset building, and is the floor below it strong enough to support the one above?" If you want true, lasting financial stability, don't just think about the top of the tower. You must start from the foundation. Before we delve into the layered compounding principle, we need to reflect on a bitter reality. Many people lose everything, not because they invested wrongly, but because they had no asset structure at all. The following story will show you this more clearly than any theory. People don't fail from stumbling over a rock, but from not knowing how to get back up. Wealth Topmax warmly welcomes you. This channel is dedicated to sharing wealth-building mindsets for those seeking financial and time freedom. If you don't want to miss out on future valuable insights, consider subscribing for free and turning on the notification bell. Let's talk about a man we'll call Mike, a 38-year-old from a booming suburb of Phoenix, Arizona. He was once a well-known local real estate trader. In just 3 years, he rose like a rocket by catching the real estate boom of 2018-2021. From practically nothing, he accumulated over $200,000 after a few successful short-term property flips. That's when he decided to truly change his life. Not stopping at land, he pulled all of his money out to invest in crypto, stock derivatives, and a tech startup a friend invited him to join. "You have to play big to win big," he would say. In just 1 year, he had almost nothing left in his account. During the 2022 crypto market crash, his account was completely wiped out. His leveraged stock positions suffered heavy losses, and the startup dissolved after burning through its cash. With no more money and no more real estate, he started borrowing to keep things afloat and then quickly fell into a dead end. "I was just a little unlucky," he bitterly recounted. If it were a different time, I might have won big. But was it really a lack of luck? He wasn't necessarily wrong for making risky investments. He was only wrong in one critical thing. He had absolutely no asset structure underneath his bets. He had no survival tier, no safety tier, and no stable cash flow. He only had a speculation tier. It's like building the roof of a house first and then trying to prop it up with a few temporary posts. The moment a storm comes, nothing is strong enough to hold it up. Mike's story is not unique. It's a story that repeats itself every single day, from novice investors to those who have a little capital from one lucky deal. Winning big once doesn't mean you understand asset management. Understanding risk and structure is what keeps you standing long after the storm has passed. So, how do you manage risk systematically? How do you know which asset to place where, which to prioritize first, and which to build later? The answer lies in the mindset of layering your assets, which we call the layered compounding principle. This is how the truly rich divide their assets into distinct layers, each corresponding to a different level of risk, from absolute safety to controlled speculation. No one can defend against all risks, but anyone can layer their risks if they know how. Now, let's dive deep into the 5-tier asset structure, one tier at a time from the bottom up, from survival to breakthrough, to understand why being rich is not about how much money you have, but about knowing how to arrange your money into a solid, unshakable structure. Tier 1, the survival zone. The first asset is not something that generates a profit, but something that keeps you alive. This is the first and most important asset tier, where all wise financial journeys begin. The survival tier won't make you rich, but it will absolutely save you from being wiped out. This tier includes assets with extremely high liquidity, incredibly low risk, and are easy to use immediately in emergency situations. This is your cash reserve for 3 to 6 months of essential living expenses, your emergency fund in a high-yield savings account, basic health and accident insurance, and other forms of cash-equivalent assets like easily withdrawn certificates of deposit. You can imagine the survival tier as a diver's backup oxygen tank. As long as you can breathe financially, you still have a chance to swim back to the surface. But if you lose this tier, you won't even have the strength to dream of the higher tiers. Life always has unannounced shocks: a sudden illness, a car accident, an unexpected job loss, a family crisis, or a natural disaster. These shocks don't just attack your wallet. They attack your psychological stability and your faith in the future. A person with a survival tier will get through these moments calmly. A person without one has only 2 choices: sell off their other assets at fire sale prices, or borrow from high-interest lenders and loan sharks. Both paths lead to a worse downward spiral. A common mistake is that many people skip this tier entirely. They think, just invest all my money. Letting cash sit idle is a waste. But they don't understand that survival money is not for generating a profit. It is for keeping your financial life alive. Many once rich people have lost everything simply because they had no cash when they needed it most, and many ordinary people have survived major crises just because they had a little emergency money at exactly the right time. So, how much is enough for this tier? For a single person, a minimum of 3 months of essential living expenses. For someone with a family, a minimum of 6 months. And for people in unstable professions like freelancers or commission-based salespeople, they should have 9 to 12 months of reserves. But more important than the specific amount is the disciplined mindset of building this tier first, before you even think about investing or getting rich. Tier 2, the safety zone. If the survival tier is to keep yourself alive, then the next tier, the safety tier, is to keep the value of your assets from sliding down over time due to the silent erosion of inflation. Being rich is not about how much you have, but about what you have left after a crisis. After you have the survival tier, the next thing you need is a protective belt for the value of your assets. That is the second tier, the safety zone. This tier consists of assets that do not appreciate quickly and do not generate high profits, but have extremely durable stability, helping you to hold on to what you have painstakingly accumulated. The characteristics of the safety tier are a low risk of depreciation, and they are not overly dependent on the short-term fluctuations of the financial markets. The common assets in the safety tier include physical gold, especially common gold coins that are easy to buy and sell, life or retirement insurance products that help to preserve long-term income, and government bonds. For some, a primary residence that is paid off can also be part of this tier. The safety tier helps you avoid being slowly eroded by inflation, keeping your money from losing its purchasing power over time. During economic crises, people with real gold, real land, and secure insurance are often the ones who can endure the longest and are also the ones who recover the fastest afterward. A common mistake here is that many people, after having some capital, often rush straight to the profit-generating tiers, completely skipping this protective layer. They think, what's the point of gold or insurance? You can't get rich from that. But they forget that in a long financial game, the one who can hold on to their assets is the one who is qualified to get richer. One failed investment can cost you 3 years of savings. But if you have a safety tier, you only lose the investment from your upper tiers, not the entire building. Tier 3, the stable profit zone. After building the survival tier and the safety tier, many people begin to move on to another stage, finding ways to make their assets generate a steady stream of cash flow without them having to work so hard anymore. This is the stable profit zone. Making money from your job is one thing. Having your money make money for you is another game entirely. When you have the survival tier to avoid having your lifeline cut by crises, and you have the safety tier so your assets don't slide down over time, then it's time to move on to the third zone in the asset structure. This is the asset tier that creates a steady, sustainable cash flow without requiring you to trade your labor for it every day. This tier has one golden rule. It doesn't need to grow incredibly fast. It just needs to be sustainable and repeatable. What does Tier 3 consist of? It includes stable rental properties, like duplexes or small apartment buildings, a portfolio of high-quality dividend stocks from large, less volatile companies that distribute profits regularly, long-term investment funds with a systematic capital allocation strategy, or even small business models with stable cash flow like a laundromat or a chain of vending machines. What is the role of Tier 3? This is a growth buffer zone that helps you to not be 100% dependent on your main job. When you have a stable cash flow coming from your assets, you begin to have the power of choice. You can quit a job you hate without the fear of starving. You can continue to invest without worrying about losing everything. You can help your relatives without the pressure of going into debt. Tier 3 is the first real source of passive income for a financially mature person. A common mistake is that people think Tier 3 has to be something big and complicated. But the truth is, any asset that creates a steady, even small stream of cash is a brick in building this tier. The stable profit tier doesn't promise to make you rich overnight, but it does help you escape the complete dependence on your active income. Tier 4, the growth zone. After building a stable cash flow, some people begin to venture to a higher tier, the growth tier, where assets can grow exceptionally, but which also come with greater risks. This is the growth zone. Acceleration should only happen when you are sure that your steering is steady and your brakes still work well. Tier 4 is where your assets begin to truly grow, no longer just for preservation or steady profit, but a zone with expectations of higher than average growth. This tiered tier includes investments with high profit potential, but which require significant knowledge, experience, and the ability to control them. We are talking about growth stocks, whose value can increase dramatically, investing in startups or small businesses with scalable models, or starting your own business and expanding its products and services. The growth tier is where you put your capital on the front line, not for defense but for expansion. However, the important thing is that not everyone should step into this tier too early. To step up to Tier 4, you must have Tiers 1 and 2 strong enough to support you if Tier 4 fails, and Tier 3 must be generating enough cash flow to maintain your life's rhythm. The right attitude here is not a game of chance, but a controlled expansion. A common mistake is that many people, upon hearing about growth, think it must be grand and massive, and they put all their capital into a single opportunity. But the growth tier does not require you to go all in. On the contrary, it demands that you have a growth strategy that is within your means, your budget, your skill level, and your circumstances. Because true growth comes not from running the fastest, but from going in the right direction at the right pace and at the right time. Tier 5. The speculation zone. When your assets have enough support from the lower tiers and are generating both cash flow and growth, some people choose to step up to the final and highest tier. This is where the most risk lies, but which can also bring the greatest leverage and profits if one knows the limits. This is the speculation zone. Speculation is not wrong. What's wrong is when you think it's your only path to wealth. Tier 5 is the final tier in the asset structure, and also the tier most prone to misunderstanding. This tier is for investments with very high risk, but also very large potential for appreciation. This includes things like cryptocurrencies, speculative meme stocks, stock derivatives, margin trading, and investing seed capital in brand new startups before their model has been proven. The speculation tier is not inherently bad. It is a part of a sophisticated financial game, but only when you know its limits. The first and most important limit is to never, ever use your survival or safety assets for speculation. The fundamental problem is that the rich see speculation as a small, supplementary layer, like the cherry on top, while the poor often see it as their main path, their lottery ticket out. The wise dare to take risks, but they always build a massive cushion first. The foolish go all in on a gamble with absolutely nothing to fall back on. How much of your total assets should the speculation tier occupy? For someone with stable finances, they might set aside 5 to 10% of their portfolio to experiment in this zone. For a beginner or someone who is not yet firm in tiers 1 to 3, they should not participate at all. Most importantly, you must consider this a zone where, even if you lose 100% of your investment, you will not collapse. If you profit, that's great. You can increase your capital. If you lose, it doesn't fundamentally affect your life. But if you go all in and lose, you lose both your faith and your future. The speculation tier is where you test whether you are controlling your assets or being controlled by greed. Conclusion. So, after exploring these 5 tiers, from survival to speculation, it becomes crystal clear that building wealth is not about getting rich quick. It's about layering your assets correctly according to the depth of the risk involved. If you understand this order, you can go far without the fear of collapsing. The poor often ask, what should I invest in to get rich quick? The wise, on the other hand, ask, if I lose everything in this upper tier, is my lower tier strong enough to support me? The lesson from the layered compounding principle is not to distinguish the rich from the poor, but to open up a powerful new mindset. Your assets must be layered from certain to risky, from survival to growth. If you don't have a survival tier, you can be easily wiped out by a single medical shock. If you don't have a safety tier, your money will silently depreciate with inflation. If you don't have a stable profit tier, you will forever be trapped trading your labor for money until you are exhausted. If you don't have a growth tier, you will stagnate while others break through. And if you enter the speculation tier without the 4 lower tiers to support you, you are not investing. You are betting your entire life. Building your assets is like building a house. With a weak foundation, the house cannot be built high. Without a blueprint, you are just patching things up. The truly rich are not disorganized gamblers. They dare to take risks, but it is controlled risk with support and with a clear stopping point. Wealth is not a number, it is a structure. It's not about how much you have, but about how you have arranged it. Thank you for joining us here at Wealth Topmax. We hope this has given you a valuable new framework for building your financial future. Don't forget to subscribe for notifications, and we will see you in the next video.